I think there's a big lesson is like take action and move quickly and be decisive in what you do. And like, don't overanalyze what you're doing. There's a bigger risk in doing nothing versus making mistakes along the way.
Welcome to the Going Long Podcast. We're back once again to continue to help to educate you so that you feel much more comfortable as well as confident investing beyond your backyard. And I am once again your host, Billy Keels, and I am really looking forward to sharing today's conversation with you because you're going to get massive value from this one. And you know what? Before we do that, just a couple quick things I would like to share with you. Number one, congratulations. Thanks to you, we continue to move up the podcast charts, continuing to have more and more people listening. And most importantly, not just listening, but actually taking the words that you learn from here or what you see and actually putting into action to help you get to your goals much faster. So if you have not had a chance yet, one of the main reasons we're able to do that is because you continue to leave your honest written reviews as well as ratings. So if you haven't, just take a couple seconds and leave your honest written review as well as rating. We've even made a really easy video for you to follow for the Apple Podcast platform. If you're not a Apple Podcast user, there are other ways, and I think it's also in that video. So also a number of you are asking, how can you find out more about the podcast and maybe episodes that you can't find on some of the platforms? Every single episode we have the solution because every single episode is on the platform. You just have to go to billykeels.com. Once you're there, go to the podcast tab and you can see every single guest, the audio version, the video version. It's awesome. Just go to billykeels.com. Once you're there, you can find every single video once you get to the podcast tab. And then there's also other resources and stuff, videos that if you want to check those out, you can do that as well. So then lastly, I know a number of you are accredited investors and you want to be able to continue to connect with other accredited investors, find out maybe about some of the investment opportunities. I am starting this accredited investor club. Would love for you to join if you are an accredited investor and you just need to send an email to aiclub@billykeels.com. Once again, that's aiclub@billykeels.com. We'll have a conversation, understand more about what you're looking to, and see if we can get you on board to the Accredited Investors Club, which is, once again, send an email to aiclub@billykeels.com. So with that stated, listen, I know a lot of you are high-paid professionals, that you are in IT sales. And listen, today's guest is an IT sales executive who's moved from a business development role into sales and into sales leadership. And also along the way realized like, hey, listen, was buying real estate properties and then started realizing, hey, listen, I've got these properties, these single family residences, and they are becoming more and more difficult to manage and they are causing me a lot of pain. And then he realized, wow, there's this thing called, well, I can invest capital because I have more capital than I have time. I'm investing that and things are moving forward faster for him. So he's going to share that story. He's going to share also some of the different things that he has learned along the way, how he's getting more freedom of his time by being able to not only invest with others, but also help bring other people together to invest in larger syndications. I know you're going to love this conversation with Sam Silverman, and we're going to get to that just after this. Whether you're an active investor or a passive investor, you really like your day job and you want to continue to go into your day job every single day feeling better, knowing that you've created the right options for yourself. At the same time, you just don't have enough time to really get your head around, spend all the hours investing long distance. Well, one way or the other, over the last number of years that I have been investing long distance, I've really understood a number of the major mistakes that you should avoid if you want to get to creating the right options for yourself much faster and being able to create more income sooner. And if you want to do that, if you want to understand more about that, I've made it really simple. You can just go to billykeels.com/7 mistakes to avoid. You can learn all the things that the 7 major mistakes that I've seen over and over again that I want you to avoid. Once again, you can go to billykeels.com/7 mistakes to avoid. So you know what? If you want to know how to alleviate the stresses of active management with a dose of passive long distance investing, then guess what? Today's the conversation that you're going to want to listen to until the very last word. You know why? Because today's guest, well, not only had early professional opportunities in the area of business development, and that's really talking to a lot of the people that are listening today, then moved into sales and sales leadership after that. And then also too, got into passive investing channel moderator. I want to know more about that. And I know you want to know more about that. And today he's the founder of Silverman Capital. And it gives me great pleasure to welcome to today's conversation, Mr. Sam Silverman. Sam, welcome to the show, man.
Yeah, Billy, thanks for having me on.
Hey man, this is fantastic. Looking forward to hearing more about your journey, the things that you have done. Also, too, the fact that you come from a sales background is something that is going to resonate with so many people that love to listen and watch the Going Long podcast. And I'm ready to get into today's conversation. So here's the thing. You know what, Sam? Everybody gets the same 5 questions, at least the same 5 questions, and a lot of stuff in between. I have no idea even what I'm going to ask. So I want to jump right in and help the entire Going Long family understand, where exactly do you live in the U.S.?
So I'm in Tampa, Florida.
Very cool. Tampa, Florida, on that Gulf of Mexico side of the United States, which is actually kind of cool. And you like the warm weather, just kind of like me then. That is very, very awesome. So
yeah, I made the escape from New York City 9 years ago, and I have no intention of going back.
Same thing kind of happened to me when I left Columbus, Ohio many years ago. And for some reason, I like the Mediterranean, sunshine and warm weather.
Yeah.
So here's the thing. Also, too, Sam, what is the most positive thing that's happened to you in the last 24 hours?
So I think actually a couple of things. We came to terms. Actually, it's outside my primary investment strategy, but I actually bought an Airbnb yesterday with one of my best friends. So more so a spot that we can go use personally. I also like from a cash flow perspective as well, which I think we can dig into, is it's 2,000 miles away from me. But also, I think there's a lot of things that the older you get, the harder it is to maintain relationships. There's life going on. So I think a really good tie with a close friend to be able to spend more time together.
Man, that's really cool. So to be able to think about not only the practical applications of saying, hey, listen, this is something that can cash flow, that you're able to do that. You were able to do that with a friend, and even gives you the opportunity to have a place to be able to reconnect. Because yes, as you have more years on this earth, and hopefully everybody has lots and lots of years on this earth, life begins to have more and more responsibility. So it's always nice to have that place to get away. So, which is awesome. So listen, Sam, so I give myself this impossible task. The entire Going Long family knows that I do this, and I try to tell your backstory in 3.5 seconds. Impossible task. So here's the thing. I would love for you to share your backstory in your own words with the entire Going Long family. And if you would do us a favor, because this is the part where everybody really gets to learn, is when you can talk about your backstory, if you can also think about and reflect on some of the major decisions that you've made to get to this point in your journey, and then we'll see where the conversation goes from there.
Yeah. So my background growing up, played baseball my entire life. Officially kind of in the washed up category now, but in high school, built and sold an event planning company when I was 15, where we would go, I was still in New York City at the time. We would rent out giant event spaces, get a DJ, kind of make like a teen nightclub where we'd pre-sell tickets. That's my first experience in sales. About 50 kids in different schools selling tickets to drive traffic to the events. So had 6 or 7 events there. Very profitable, sold the company to a friend. Actually kind of paid my entire way through school. From school, played baseball, University of Tampa. From there, walked into an SDR function, which is like the entry level, hitting the phones, sending emails function in sales in the tech world, which has been probably the best first accidental step I could have taken, where you meet a ton of great people. Kind of from there, moved through the ranks into sales leadership, right? Where my next role built out a 60-person global SDR team, so I had a ton of opportunities to go travel. A lot of people from different cultures. Now I currently lead a sales org for a company called Metric. And then on the real estate side of the house, you kind of look at when you go in sales, I think sales is probably the best role to start out in. Right. It's a pure meritocracy, where other roles you're spending years and years and years to make marginal percent increases. Or in sales, if you perform well, one, you're highlighted and have new role opportunities for you and more responsibility. But 2, you're compensated directly for your work. Right. In very few other functions are you compensated directly for your performance. Right. Typically, you're given a salary, maybe a bonus here and there. But in sales, it is truly a based on your role and how you deliver on it. So from there, started doing well fairly early, and always kept my lifestyle to a minimum, where you're like, okay, now I have extra cash to allocate. So in the real estate side, I understood the concept of passive income really quickly, right? Things that you put time or money into up front and then pay you continuously over time, and they're hands off. And got into single family, found out it was not hands off at all. So it was, you sort of have that battle of just headspace. I'm a big believer in headspace, where you have a limited amount of, top tier decision making throughout the day. And there's certain higher level decisions and activities you can be doing. For me, I think the, clear ending point of myself in single family was I had a tenant who drunkenly drove their lawnmower over a sewer line, and I was getting calls for hours from the property management team. So that was a clear indication. I think at the time I had 8 single family houses, scaled up really quickly, and realized that if I keep getting more of these, this is now a full-time job, and it's not paying me enough to be a full-time job relative to my other potential role in sales, right? Love my role in sales. I think it's a great career. People should, give it a shot, go try sales. And it ended up being just a massive time suck where it wasn't worth the return on time and the return on overall headspace it took up, and attention took away from other areas of my life. So from there, did a lot more research, and then quickly kind of found passive investing, right? Where you're investing into a syndication, basically getting fractional ownership in a more sturdy asset class, right? That's not a single family house that's based on emotional decisions in terms of price points or the market, right? Buying more recession resistant assets that are truly hands off. And then it's kind of snowballed from there, invest in a bunch more passive deals as a limited partner, and then quickly realized that when you look at kind of larger commercial type deals and transactions, there's 2 things that matter, right? 1, you find a deal. 2, you find capital to go allocate to that deal. And I kind of fell more in the latter portion of that, just from the sales background, right? Sales network of people, right? And kind of carrying over your personal brand from your sales function into a new career where people are willing to take a bet on you. So I think that kind of helped, really move that side of the business forward in a big way. Because people in sales, if you look at it, I was around people making $200,000, $300,000, $400,000, $500,000 plus each year, and they were spending 60 hours a week working. And when they're not working, they're like, I want to go do my own thing, spend time with my family, go work out, go travel. So for them, the being super hands-on investing wasn't as appealing. So it's kind of a really good combination of things that really helps start what I'm doing today, and definitely just helps people around you as well get access to things they may have not known about.
Wow, man. So there's a lot of different things, right? And I guess at the end of the day, especially when you're a high-paid professional and you are, well, like you said, you get a better return on your time when you're doing something that you like, but you just may not even know that there's something else out there. So, I would be curious because of the things that you've said, and it definitely resonates a lot as you talk about getting started in the SDR role, which is really like kind of sales development or the business development kind of aspect. And then you've seen from there all the way through to sales leadership. And I guess probably the biggest question that I have for you is, as you were kind of going through that, because sometimes as you were going through the process and you got to your 8th single family home, and then someone ruptured a sewage line, that would not be very cool. That's just my commentary, not what you said, but that would definitely not be cool. I'm just curious, like, kind of, was it the frustration that you were getting the call, or was it the frustration that your tenants were having, the issues? Because I'm just want to get to the kind of, what was it exactly that kind of made you say, you know what, I can't just add house number 10, 12, 15, 16.
Yeah, I think that you started seeing it more and more, right? Like, I'm a big numbers geek, and you start looking at it like, okay, if I can make myself $200 a house, and you start stacking those up, you're like, I need a lot of freaking houses to get to the place where I want to be. That gives you the freedom that I'm after, right? Like for me, I'm not a material type person at all. Like mine more so is much more the freedom of time, freedom of choice, right? Like I think a big point, and I'll get back to your question in a second, is like you go to some corporations, you see people who are 55, 60 years old and just freaking miserable in their job. And they're there because they have to go support a family. They have to support themselves in a certain way, or they're tied to a lifestyle that requires them to be in a place they absolutely hate. So my kind of chase of all this was making sure I never have to do anything I don't want to, or that I don't feel ethically right doing. So it allows that freedom of choice and freedom of time and freedom of who you're around, which is a really big piece of it. But to go back to your question, on the single family side, it was more so when I looked at it, okay, how many of these do I actually need? How many transactions? How much time spent is this? I can make more money in my day job, right? Because if you look at take a mid-market sales, for example, say their comp package is 100, right? $100,000 base salary, $100,000 variable goal, they hit their $1 million quota. For them, if they hit $500,000, they're like making $150,000 that year. If they hit $2 million, they're like making $400,000 that year, right? So it's a massive swing in terms of earnings and upside. And I use that example just to reflect of like, okay, if I can really grind in my roles and be more the latter than the former of those two people, that those $200 a month that I'm making from each house and time that's being put into it is way better spent doing advancing my career. And it's also just more like that was more exciting to me personally. I like that side of it. So it's more so just the opportunity cost of all those things I just talked about, of why it led me to just looking at spending more time in my career and looking at opportunities to become more passive while still in the same field. You think passive income, it's either sweat equity or you buy it, right? And I was in the position of like, okay, I can grind in my day job and then go buy it instead of having to put sweat equity into it.
Yeah. And so this is a really interesting concept that you unpack, right? Because I spend a lot of time speaking to people that are earning $500,000 and more, right? And so there's a different approach to that person than the person who is earning 90,000, 150,000 in terms of where they need to be, where they need to invest their time. Also, you mentioned that person that is kind of miserable in their job. I've also seen lots and lots of people, I'd love your take on this as well, that it's not that they're miserable in their job, but they don't know anything else to do. And the only option are either continue to work more hours because they know that they can go from 400 to 800, or it's to work more hours or invest more in the stock market and hope that the money is going to, go buy low and sell high in a couple months. What's your take on that?
Yeah, well, I think jobs are great for some people, right? Like I think some people want to go to a place, they want to do their time, they want to leave and not think twice about it ever again. I think there's a different group of people too who like being obsessed and inspired with what they do, where it's not just a clock in, clock out type thing. But yeah, I think there's more opportunity for people to educate themselves on what's out there. And like, I love shows like this where it's free content, right? Where it's free things that's how I got started in real estate as well. Personally, is just listening to podcasts like this and learning from a ton of people. Granted, take everything with a grain of salt always, because it's just people's personal take around their experience. But there's so much free content out there to at least help open your eyes as to what's possible. Then it's on you to actually go take action upon that. Like I think in real estate too, and we can get into this if you want to, like there's a massive issue with just paralysis analysis in real estate, like underwriting the perfect deal, like in the perfect investment opportunity, digging into the 8th decimal point. When in real estate, to me, it comes down to a few things, right? Number one, just anything in life, it's the people, right? Like I bet on people all day long. And you look at investing, my first take is like, I manage my mom's money. And if I wouldn't put my mom's money with this person, feel comfortable doing so, like the gut test, there's still nothing better in life than the gut test. All the numbers you want to run, all the scenarios you want to play out, the gut test matters so much. Where if that deal, that person, that situation makes you feel off, like walk away from it. But I think people do spend a little bit too much time in paralysis analysis mode in real estate. And once you get sucked into that path, it's kind of like a Richter scale. The deeper you get sucked in, the harder it is to come out of that and make decisions. Like being risk averse and mitigating risk is always important, but taking action is extremely important to go do. Otherwise, you may find yourself like that person who's still in that office chair at 6 years old and just not thrilled with where they are in life.
Yeah, normally that person, I don't know normally, but it's probably a high probability that person that's sitting in their chair, they have probably, and I'm just going to maybe exaggerate a little bit, but that person has $2 million that are sitting there or the equivalent wherever they're living in the world, 1.5 million euros. Sure. But had they taken more action, they could probably have 5 million or 8 million. And so sometimes when you overanalyze things, not saying don't be prudent, you absolutely need to be prudent and you need to go through your due diligence and you need to do your gut check as well. But sometimes it's a matter of also recognizing that money is energy and that energy needs to be released and be able to be moved around. So one thing that go ahead. You wanted to add something?
Yeah, I was going to say it's also like it's calculated risks, right? Yeah. Like the way I view this is if my downside is losing 20%, my upside's 5x, done, right? Like when you look at a risk, is your downside much smaller and much less likely than your upside? If so, do it, right? Like there's, opportunity cost if you want to waste them for something else, entirely fine for making a decision, but the downside risk and making sure that what you're looking at investing in, if you're covered in a lot of bad scenarios and your downside's not too big, but your upside's a big multiple of your downside, that's a move you should make, right? You should be making moves that your downside is covered and your upside is more meaningful than your downside.
Right. And one of the things that I would add there is obviously every person has their risk threshold and all that other kind of stuff. But the also, I would just add that the point there is in order to get to a point where you feel comfortable, you have to take action. You have to consistently take action, because if you just analyze things, but you don't ever actually put any money in the game, then you're never going to know what it feels like. So, it's about analyzing, but then it's also about taking action. So on that with you, one of the things that also I know we talked about and we're just, because a lot of times this happens with high paid professionals and you're doing that and we're talking about it a little bit, but I kind of want to just go direct here. Why in the world would somebody who is in that, 400, 500,000 a year category, right? Because they're always pushing the limits on the income side of the equation. Like, why even think about real estate when you could just continue to do that? Why real estate?
Because you'll have to continue to do that then. Right, where it's the freedom of it. So say, for example, you have person A who is making $500,000 a year, say they live in, a high paid, a higher tax state in the US, they're taking home $300,000. Say their lifestyle, they've got the $5,000 mortgage, they've got the 3 cars, right? Look at all those expenses. There's $5,000, $10,000 left a month, maybe, right? Likely less. So if you look at it, like I think, especially in the US, I'm not sure as much in Europe, because I'm not as familiar with it. But lifestyle creep is a massive thing. Like you look at person A is making 500 grand, taking them 300 and spending 290, right? If they stop working within a few months, they're screwed. Yeah. So you have to go keep up with that lifestyle then, where if you take, for example, person B who's making 300 grand, but they're stocking away $50,000 every year into, say a real estate syndication, for example, and you look at those compounding over time, right? You'll have millions of dollars there in, 5, 6, 7 years, right? If those keep performing well. Mm-hmm. But it gives you the optionality then, right? Where if that person then has, $5,000 a month of passive income, and they can then go keep snowballing that back into new deals, into new projects, and reinvesting that, the compounded snowball effect is so meaningful. And then it detaches you from that lifestyle, right? Where I'm a big believer, if you want something, say you want a new car that's $1,000 a month payment, instead of putting, $8,000 down for that car and buying it in cash, go put that $8,000 and it'll actually pay you cash flow from that. And then your principal balance is growing, whether it's buying a single family house, for example. I don't recommend it, but if you say you're going that route, you're getting the pay down, you're getting the appreciation, you're getting the cash flow from it. If you're investing in kind of the projects that I work on now, it's kind of like the large syndication type deals where you're investing truly passively. You're getting cash flow each month, your principal is growing. So it's allowing the money to go work for you versus just spending it on a lifestyle.
Yes. And so there's 2 things that you said there that I want the entire Going Long family to understand, because one of the reasons for my asking my question, you talked about 2 things. One of the very first comments was you talked about tax. And then secondly, which tax, and I'm going to extrapolate here a little bit more, is to think about tax efficiency in terms of the way that you're placing capitals. And the second thing is to be able to have and create more options. There's another part of that. So as you start to help other people that are in this high income, because there's one thing is about having high income, and another thing is having high net worth. But as you're helping people with the high income, it's about not only can you help them make more income, but that income to be done in a very tax efficient manner. And this is why it's also important, and the Going Long family knows this, to have a strong team of professionals to help you. Because when you can see, as part of the analysis, is depending on how you are earning your income, that income has a certain kind of tax bracket and certain type of tax treatment, whether it's active income or whether it's passive income. IRS definition, sure. Right? Not Sam and Billy's definition, IRS definition of passive and non-passive income. So I appreciate that you gave us those insights as well. Wow, don't you just love this conversation? This is amazing. This is fantastic. And so just really quickly, I just wanted to remind you, for those of you that are looking to create more options for yourself, get there faster, and do that with long distance investing, make sure that you go to billykeels.com/7 mistakes to avoid, so that you can avoid all those mistakes, get to your goals faster and sooner. Once again, that's billykeels.com/7 mistakes to avoid. Now back to the conversation. And then one other thing, because this is something that also gets to the heart of the show, which is about investing long distance. And as you and I talked about before, like I take it to extreme, right? I live in Europe. I love living in Europe, and I love investing in US-based real assets, right? Real estate, energy equipment, ATMs, all kinds of different stuff, right? But just out of curiosity, because this is sometimes, you mentioned that you're in Florida, and I know that you work with people that are in lots of different states. So what is it that you also do, or what have you seen that is one of the reasons that someone would go against kind of like what is the common culture, which is if you're going to be a landlord, you buy this property and you live right in the place where you can drive to it in like 15 minutes, to that person that's saying, hey, listen, I'm going to put $200,000 on this particular investment opportunity, and it's like 2,000 miles away from me. So the whole thing of helping people, why I understand that long distance investing is something that they could actually include in their portfolio or their investment strategy.
Yeah, so I think that old investing in your backyard thing is great if you have a meaningful competitive advantage there and you can get deals that are far discounted because of who you know there. But if you can go do that, great. But if you're like, when looking at investing long distance, it's pretty much all I do personally. I think I have one project that I've invested in that's like within an hour with me. Everything else is, I'm in Florida. And for those in the States, I have projects in the Carolinas, in Texas, in Arizona, in Idaho, in Colorado, and you're just spread out. But the big thing is, like, you're looking at these larger commercial projects, is that the groups you're investing with, they have boots on the ground there, and they have a management team in place that's local to that area. Why I love bigger deals, think apartment complex that are 100 units or more, you can have people on staff in those buildings at all times, which allows you to have an extension of yourself there. And you can then just manage, property manager in that group, where it's allowing yourself to be truly hands-off. So from the investor side of it, if you're kind of picking opportunities to invest into that are truly passive, right? Being a limited partner in a larger transaction, is that the operating team will either be in that location or they'll have people in that location that can handle everything, right? When you look at an 100 apartment complex, for example, you like to have at least one leasing agent there, one maintenance person there, right? So you have people who are handling all of these things that come up, and they have their local vendors, they have all these people who can handle everything for you. And you're allowing us to invest in a better area, right? For me, I love New York. I visit my mom there all the time still. I don't want to ever own a single thing in New York ever, right? The landlord tenant laws are brutal, right? It's a massive liability to have property there. And it's also priced to a point where you're likely not receiving any kind of cash flow. And you're also, your upside, it's too volatile when looking at the risk associated to it for me. So for me, I love the Sun Belt, right? Carolinas, Georgia, Florida, Texas. I'm very heavy in Arizona, right? Markets in which have favorable landlord tenant laws, where you can kind of pick the legislation that makes the most sense for what you're doing. Also giving you upside in terms of appreciation, but also giving you cash flow in the interim, right? It kind of gives you the best of both worlds when looking at how you choose to invest. But it's more so you invest where the better deals are versus where you personally are. Like I have invested in probably 20 plus limited partner deals. And I've seen, as of, a few weeks ago, I walked about 7 of them. Before that, I had not seen a single one before I put money into it. And it's more so you bet on the people. Like, I think when you look at how do you evaluate an opportunity as well, like I have 3 criteria to look at in order. Like, one is the people, like who's operating this deal. I think a big thing that you want to understand is, what did this person give up today to do what they're doing? How do they handle things when stuff goes wrong? Even in a deal that performs great, things will go wrong in that period of time. And you want to understand how this person can react. And then I think you look at what area do you want to be in, right? In terms of location, market demographics, right? You want to see income growth, you want to see job growth, population growth, right? You want to see overall diversity of employment, right? So say, for example, if think back to Detroit in the car manufacturing era, when that went overseas, that entire area went downhill because it was so reliant on the manufacturers. You want to see a diversity of overall roles and different professions, that if one industry is hit, you're overall in a good place still. And I think third, it becomes the deal itself, right? Are the fundamentals of this deal itself, are they conservative enough where things can go wrong, you have buffer room, and you still get to where you want to go? Or if that stuff doesn't go wrong, all that becomes upside.
So I love that. And it's very much in line with what I'd like to share with the Going Long family is first and foremost, you need to understand personally, what is it that what is the benefit that you're looking for, right? And if we talk about just real estate, a lot of times it's cash flow, or talk about tax benefits, or it's appreciation over time, or equity buildup, and all these kinds of things. And then afterwards, you go to the location that's going to give you the highest probability of being able to achieve that result. And then from there, then you find the team that is just the A-class team that is understanding the location where you are going to be based in, and then also is aligned with your thought process. And then afterwards, if you can invest in a 150 unit apartment complex, a piece of energy equipment, or something else, or part of a business, then you know what, all those things are aligned. Sure. And so it's going to give you a much higher probability of getting the result ultimately that you want. There was one thing that you said though in the very first part, and I would love to pick up on it and maybe drill down just a little bit. You said you want from the team that you want to understand what that person, and let's say maybe that person or that team gave up to do what they're doing. What do you mean by that?
So when you look at someone, say, to use the example again of someone who's buying a large apartment complex and they're the operating team on it, you're investing in them in that project. I want to see someone who has something to lose, whether it's financially, right? I want to say they have skin in the game. Say, for example, the total equity needed for the deal is $2 million. I want to see a chunk of that capital coming from them, right? Coming from the operating team in that deal. So they have some skin in the game financially. I want to see that they left a career or they built a brand that's big enough where if this deal doesn't perform well, it negatively impacts them in a big way. Reputationally, whether it's raising capital, whether it's getting a new loan, whatever it may be, just kind of building their brand that way. Or they've left a meaningful career to go pursue this, right? They've had big success in another area. Take, for example, Joe, the house flipper, who's making 60 grand a year, right? Nothing's wrong with that at all. But if I'm betting on someone who's going to then provide for their family on what they're making, Joe's level of success versus, Peter's level of success, Peter left a $500,000 VP of sales role. I bet more on Peter because I know that his background is in operations and people and managing relationships. And then also his level of financial success, his bar is higher than Joe's for what he views as successful. I think he'll carry those things into his new venture in doing this. If it's someone who doesn't have an overall larger track record, right? So seeing someone who's just given up something. And the biggest thing too is when things go wrong, right? You want someone who will be collected and rational and make decisions that are best for the business versus being emotional. So what I like understanding is someone is, hey, what's something that's gone awful for you in a transaction? If it hasn't gone awful for you in a transaction yet, just in another area of life, help me understand how you handle that. And I think for me, that's a really big peace of mind thing. So that when stuff hits the fan, they can react in a way that you feel confident having them make decisions under pressure for your capital and your investment.
Love that. Appreciate you drilling down there. And also too, you've repeatedly said, and it's absolutely correct, is when things happen, because things always happen. And whether it's whether it's in your corporate career or it's in your your investing career, those of you that are watching and listening or running on the treadmill or cooking dinner or whatever, you are you're the best of the best because, well, you know how to handle situations that are not part of the playbook. And the exact same thing is going to happen when you start investing, whether you're doing it actively or you're doing it passively, because you have to then do due diligence on the teams of individuals from just looking at paperwork and marketing material and all that stuff. But then also, the gut check, like Sam's talking about. These things are really, really important because yes, stuff always happens every single time.
And you can have a deal that's entirely successful, right? Beats projections, overall great deal, but there may be things in that transaction that aren't pretty for a period of time, but you're still getting to the end result that you all planned on, if not better. But just even in a great transaction, there may be some bumps along the road. And how you handle those bumps may dictate the entire success of the whole transaction.
Without a doubt, because it is the reactions, and your teams, your investors are looking for you for leadership to understand, okay, well, how are you going to help to navigate us through this stuff? Because it is occurring. So I guess one last question before we kind of get into the going long final three, because we got to get into the going long final three. Like everybody's waiting around to hear your answers to these questions because it's like the thing, right? It's just to understand, I guess, kind of if you look moving forward, like what do you see the next? I don't know, the long term, and nowadays it's 6 months, right? What does the next 6 months, 6 to 12 months hold for Silverman Capital?
So it's always a few things, right? One, we're consistently, producing new projects for our investors. So always growing the actual investor base we have, because that allows us then become more aggressive, make offers for properties, knowing that we have funding backing us when we do get them. So it allows us to secure more properties that way and get better deals for our investors. And the biggest thing for me is then always networking with new operators. If you can look at my role, primarily play a role that's all investor based, right? Helping source capital, helping do due diligence in deals, investor relations. So for me, I more so partner with people who are actually boots in the ground operating teams there. So it's always building that relationship of new operators to get into new markets. Because I think a big thing that the investors like seeing is diversity, right? Like being able to, say you have an investor who's got $1 million to allocate. They may not want to have $1 million in Class B apartments in Phoenix. They may want to have some in Austin or Florida or the Carolinas or Georgia or self-storage or energy equipment, right? They like so more so kind of bring the full suite of offerings to the investors, help them be diversified, and also myself. I invest in all these deals personally as well.
Okay. I love that. And then, just for those people that are listening, right? Because we've mentioned it before, and I know you've talked about the syndicators. So you're bringing particular goals and dreams that quantify themselves in capital, and then you place them with operators. Give us maybe one tip that you have found to be successful for you in terms of being able to make the connection with an operator and seeing that, hey, okay, this connection, but this is one that I think is going to work for my investors.
So biggest thing is I wrote a check first as an investor every time before I ever help them source capital or be on their operating team. I think it's really important to understand what the experience is like, right? In terms of communication, in terms of how they handle things, right? You're seeing much more firsthand when you're an investor and their updates. So I think communication is a big piece of it for me. I think just their level of transparency, right? Like that's a huge piece of it, because in these deals you get into are black holes, right? You give your dollars there and you really don't have a way of checking in what's going on. So for me, it was just more so people that I felt comfortable with doing things the right way. And the right way is my perspective, right? So it's not, the true right way, just more so how I've seen it personally. But just people I felt like I've had a good experience with who've been at or above their overall projections from deals we've been a part of, and just how they've handled things throughout the transaction of actually following their business plan and achieving it. But just first and foremost, it's putting my money where my mouth is at first, and then kind of helping vet deals with that for future investors. The risk is more on my end than theirs. Right, that first deal of me writing a check is far more risky than them writing a check for the third deal and partnering with an operator on.
Yeah. Are you typically waiting like you've done your first deal and then you wait like a year later to see how the whole cycle's gone, and then afterwards that year you're creating the relationship with the operator, and then it's something you would potential, or is that like you've written your check and then it's 2 years, or kind of do you have a standard that way?
It depends. Like there's one operator who was, my first deal with them after was about 3 months, and I've now done 9 deals with them. Right. And for them, it was just, they were top notch. Others I'm more wary. Right. So this group blew me away in terms of how they operate, reporting team, right? There's, a full 20-person team. They have new property management team in-house again. So like things like that, it's all it depends, right? So like it goes back to the gut check piece of it, right? It's you look at kind of my role in these scenarios is I'm basically betting on the operator, right? And by putting my money there first, it allows me to be more confident in my decision to do so, and the due diligence there. And then it's basically saying, bring other people to these transactions as well, where they're betting on you, who's betting on them. Yep. So I think it's more so what your level of risk tolerance is and what your level of comfortability is. Like I'll be very risky with my own money, with investors' money, not at all, right? Very, very conservative, and making sure that there's a lot of buffer room and transaction and with the people. So it's more so just whatever you're willing to risk your brand on. And I'm very conservative how I approach that.
Yeah, no, and I appreciate that. And it also is, everybody is different. And you've mentioned it a couple of times, and it is a matter of you have a very clear vision of what it is that you want to do, the benefits that you're looking to derive. And so that gives you the clarity of vision to be able to go out and act. So I think that's one of the other things that I'd like the Going Long family to really take away from this conversation, is the fact that you have that clarity and that allows you to execute more efficiently. So with that though, listen, Sam, like I said, man, everybody's got to get the going long final three. So we're at that time. And the thing is, I never, ever ask anybody, and I'm not going to start today, asking you the going long final three, unless you tell me that you're ready for me to ask you. So are you ready?
Yeah, let's do it.
I know. Why did I know you were going to say that? Listen, so here's the first part. We started with you over in Tampa in the US, and now I'd like to bring it back to this side of the pond over here with me in Europe. And I would love for you to share with the Going Long family, what is your favorite European city that you've either visited or is still on your bucket list to visit?
So honestly, where you are in Barcelona, it was a long weekend there, but it was absolutely beautiful. I love the food. People are really nice. And then I was in Greece for 2 weeks this summer. So I loved Crete. If the time zone wasn't so tough for me to work there, I probably would live there. It was beautiful. People were awesome. Amazing food. Yeah.
So I'm going to put you on the spot here. Barcelona, Crete. Which one? I won't be offended.
I think it's different, right? Like, I think it's different. Like, I think it's more comparable to go compare, like Athens to Barcelona, or, even like Mykonos to Barcelona versus Crete. Like, Crete's much more island than Barcelona. Still like a metropolitan city. And I just have a soft spot for big cities, still being from New York. I lose a little bit of that in Tampa for better quality of life in certain ways. But yeah, the city and the people were awesome. So still working on finding a big summer to go spend, kind of hopping from place to place there.
All right, right on. Cool. So here's what I'll do. I'll take Barcelona. We'll take that as your answer, your final answer. Yeah. And then, by the way, make sure you hit me up before you head over here. After, I guess, almost 16 years, I do know a little bit about this town, so would be happy to do that. So question number 2, the Going Long final three, Sam. And this is actually it's based on a lot of the experience that I've had and I've seen with people who are successful. I consider you also to be someone to be successful. If not, you wouldn't be here, of course, because you're sharing lots of relevant experience with the entire Going Long family. And one of the things that I have noticed about successful people, Sam, is they tend to be very successful, typically because they do everything right the very first time, have no mistake. Did I just say that? I think I did say that. I think I got a little bit nervous, or maybe it was just kind of a joke. It's an inside joke with me and the Going Long family. So the reality is, no, listen, everybody knows. Everybody makes mistakes. We all make mistakes. And the thing that I have recognized, Sam, and I've been fortunate to see and meet a lot of very successful people, is really successful people, they make a whole lot more mistakes than most people, like a whole lot more. And the thing is, they do one thing very, very differently. And this is no joke. What I've seen is that very successful people always stop after the learning opportunities or the mistakes, especially the relevant ones, and they figure out kind of what is the learning that they can take away from that. And then secondly, they take that learning and they put it into action so that they can minimize the chance of that happening again. So I guess my question to you is not thinking about the mistake or the learning opportunity, but what's the one lesson that you know that the Going Long family needs to hear today that they can go put it into practice so that they have a less chance of making the exact same mistake that you made?
So if you want to be specific when looking at like a mistake that I've made that I can kind of take a lesson from it, I got super aggressive, like right out of college, had some money, buying single family houses. I put every one of those houses on a 15-year loan. The 15-year loan, the 15-year mortgage is the biggest scam in the entire freaking world. So it's more so my view on it. I'm like, hey, I'll get 15, 20 years properties. I'll pay them off in 15 years. I'll be 36, 37 years old, and I'll be good. And you just have no protection in that scenario because you're basically a wash in terms of your cash flow versus your expenses. You have a few major things happen. You have to feed those properties. Or think about if you have properties, if your property is making $50 a month, you can have as many of those as you want to. Properties are losing $100 a month with a new roof that's $5,000 to $6,000. You can only have a limited number of those before it impacts your business. So I think that's one, is just the 15-year mortgage is a scam by banks. But second, I think there's a big lesson is like take action and move quickly and be decisive in what you do. And like, don't overanalyze what you're doing. There's a bigger risk in doing nothing versus making mistakes along the way.
Love that. So be decisive, take action, and also think about your 15-year mortgage before you before you take that out. So going to the very last one of the Going Long final three. This is really about feeding our mind. So what is the one book that you would recommend to the Going Long family today?
So there's two. One is The Psychology of Money, which was awesome. It kind of just really helps you understand how people think about just overall finances and kind of your background. And it's not tied to real estate at all, but it helps give you perspective on how people think. And I think that's a huge area where you can level yourself up, is understanding how people operate, whether it's sales, whether it's whatever kind of business you're in. The more you understand how people think and operate, the better you can align to making things mutually beneficial. And the second, it's the art and science of winning and losing, where it really digs into how do you create competition, how people think. I love this example they have in the book. Say you, myself, and someone else are running, and you guys run a 6-minute mile and I run a 9-minute mile. You guys aren't pushing me to be better. I'm more so like, damn, I'm really far behind you guys. I'll probably just go trot in the back. Where you and the other person in that 6-minute mile group, you guys are pushing each other to be better. I know it kind of ties to our conversation earlier where you have a group of friends who now you're competitive with them. You guys push each other. Like, it's great to have that. So it's more so understanding your circle of people in which you're around who can help push you and be better, making sure it's the right circle of people, and understanding how to create environments, whether you're in a sales organization, a company, whatever it may be, to create environments that foster competitive competition in a friendly way that helps everyone be better.
Awesome. Now, art and science of winning and losing and the psychology of money. Love that. And appreciate you sharing those with us, Sam. And I'm just going back to the very beginning of our conversation, and you're talking about, the starting up with the good stuff and being able to purchase a new property with you and a friend. And so already thinking about friendships, partnerships, the importance of that, talking about baseball career and then also event planning, which is one of the things. I actually used to work in event planning for a really, really long time. So I know a lot of what goes into that. And when you're doing it at 15 and selling tickets, all that kind of stuff, we'll talk about that later. And then from there, getting into really like the business development side of things, evolving through that in the corporate role to be able to get into sales and sales leadership. Also from there, realizing, hey, look, you want to be able to do something else with this excess time, this excess capital. You got into the single family stuff afterwards. Single family, after you got to 8, someone broke a sewage pipe thing. You're like, wait, hang on a second. There's got to be a better way to do this. And then along the way, you found the ability to take that excess cash, place it somewhere else through syndication, right? And being able to invest in larger assets. And then one of the things that you didn't say, but I'm going to add it here, is being able to invest in teams and having more control through direct investment in those types of assets. And always taking doing it first approach has also led you to the opportunity to now recognize that you can help other people that are looking to invest in direct investment companies and doing that through syndication as well. So you've shared so much value with us today. And I know that so many people are like, wow, man, this Sam dude is really, really awesome. And I want to find out more about what he's doing, what he's got going on at Silverman Capital. So help us understand, what's the best way for the Going Long family to connect with you, Sam? So super active on LinkedIn. My website, silvermancapital.co.
LinkedIn, website, email, sam@silvermancapital.co. Super responsive in all those areas.
Awesome. Perfect. So sam@silverman.co on the email. Yep. And then also one of the things that I would ask for everybody here on the Going Long family, when you reach out to Sam, because it's something I ask all the time, especially on LinkedIn, because I love LinkedIn as well, make sure that you leave Sam a personalized message so that he knows that you were listening or watching him and me speak, and that's why you wanted to reach out. It's really going to help you and Sam to build that bridge and make the connection even faster. So with that stated, man, Sam, listen, I like to just thank you so much from the bottom of my heart for investing your time, your experience with me and the entire Going Long family, man. Thank you very much.
Yeah, I had fun. Thanks for having me on.
All right. Awesome. And Going Long family, really want to appreciate you and thank you for investing your time with Sam and I today. I am really looking forward to welcoming you back on the next conversation. So until then, go out and make it a great day. And thank you very much. Wow. Don't you love hearing from top-notch experts in the field? You know, when I was getting started, I really wish that I would have had access to such experts. And even more, I wish they would have given me like a really simple list of things to follow so that I could have gotten to my goals much faster and been much happier even sooner. So that's why I've created for you the 7 things that you should avoid in order to be successful in long distance investing. And you can pick that up really easily by going to billykeels.com/7 things to avoid. And also, if you liked today's episode, don't forget to leave a 5-star review. I'm looking forward to seeing you on our very next episode, so go out and make it a great day.